Hello, class, and welcome to our 12th lecture series on international finance. And I'm your instructor, Jamal Haider. So, to begin with, I have included concept checkers from our last class chapter, Government Influence on Exchange Rate. So, start recalling the things that we have done in our last lecture. We talked about government control, we talked about different exchange rate systems, right? What will happen if we peg the currency, right? Dollarization of the currencies like that. So read that one. Let's talk about the concept checkers. Here we go. So read the question and answer after thinking. So please, a weak dollar is normally expected to cause daily.
D.
B or D?
D.
D, okay. Jalap,
D as well.
Kathleen,
I have D as well.
anyone else who has a different idea here? Guys, well done. A weak dollar will cause your exports to increase. When exports increase, employment is going to be there. People are going to have employment. When people are going to have employment, their income going to rise. When their income going to rise, they have too much money to spend, then inflation start rising. So my question is, inflation is bad or good? Anyone who want to comment on that? Whether inflation is good or bad? Fabian.
Inflation is slowly inflation is good for economic, but in this case we are talking about high inflation and low employment rate. So
Wait for a second. So even high inflation is, we cannot categorize it as bad or good, right? Inflation is good for economic development, right? When people have too much money, when people are having money, they want to spend, then businesses start booming as well, right? Because people have money, they want to start their own business, or they want to expand the business, they want to be, acquiring the business. So this is good for the economy. But too much inflation, so every country has its own standard, like according to the volume of the economy. If I would say 10% inflation is bad for Bangladesh or India, then I would be wrong. Maybe 10% inflation is good for them, because over there they have very low unemployment, very low employment, or they have huge unemployment over there. But if I say 10% inflation is bad for US, then you can say, okay, bad. Maybe high inflation for US is just for 2 or 3%. So every country has its own, percentage to be in that one. And that is the job for the central bank to maintain that, whether we should increase inflation. And recall our last lecture, discussion when we talk about central bank intervention through sterilization and non-sterilization, right? In which they control the inflation and directly involve into currency market as well. So that's why they do that, to control the inflation as well. Okay, let's talk about this. The currency of country X is pegged to the currency of country Y. Assume that country's Y currency depreciate against the currency of country Z. It is likely that country X will export to the country Z and import from country Z. So you need to tell me that whether its currency will depreciate or appreciate. So based on depreciation and appreciation, how about its import and exports works? Think about that. Crystal?
I think it's C, since there is appreciations in the country Z. Yeah, they will export more and import less.
Okay. How about Ping Ping? Ping Ping.
I also think it's D, sir.
It's D. Okay. So we are having two opinions, C or D. Okay, not.
I'm not sure.
It's okay. I just want your participation. Not. What is the answer? What do you think?
I haven't finished it yet, but I guess it's C.
C. Lota?
I thought it was D. Yes.
D. Okay. Kathleen? Can you hear me?
Yes, I think maybe C.
C. Okay. Fabian?
C. Yeah.
Right? Why not D? What is pegging? If currency X is pegged again Y, it means if the currency will appreciate, Y will appreciate, X will appreciate. If currency depreciate, X will also depreciate, right? So currency Y is depreciating against currency Z. So it means currency X is also depreciating against currency Z. So what will happen if currencies goes down? Its goods look cheaper to the outside world. It looks cheaper to the country Z. Country Z will import more from country X and exports less from country X. So vice versa. Country X will export more to country Z and country X will import less from country Z. Right? Answer is C. Now, how about this? True, false? A major advantage of the euro is the complete elimination of exchange rate risk on transaction between participating European countries, which encourages more trade and capital flows within Europe. True, false? Jalop.
True.
True. Haley.
True.
Lota.
True.
Fabian.
Wait, I'm still reading.
Kathleen.
True.
I'm not sure.
Answer is true. Because when the European countries join hands together and they are trading only on one currency, then if they trade whether from Italy, whether from Greece, whether from Cyprus, only one currency is going to be needed. So exchange rate risk is going to be eliminated, right? And it's going to be, it encourages more to trade with one another rather considering the exchange rate risk and capital flows, right? How about this? The market forces are determinant of exchange rates in a freely floating exchange rate systems. True, false? Guys, participate in that. True, false? Ping, ping. Marilyn,
True. True, maybe.
Marilyn, Crystal.
Yeah, true as well.
Good. Because in freely floating system, there is no government influence, only supply and demand are the market forces who determine the exchange rate system. So from chapter 7, we will be covering these two topics, and then we will move on to chapter 8. We'll be covering different, the other parities. So let's just talk about first objective, which is covered interest arbitrage. So what is covered interest arbitrage? In which we want to capitalize or we want to profit from interest rates and eliminate our exchange rate risk, or in other sense, in financial terms, we want to cover our position. What do we mean when we say about cover our position? In which we eliminate our risk of converting the currency. And interest arbitrage, we try to profit from interest rates. Arbitrage means risk less profit. So we want to make sure that, okay, we want to get some profit. It's less risky. Why? Because the other country is giving us high interest rate. So we don't have to do anything. Just put our money over there. That's it. So what if we convert our money back after 1 year or after 6 months when we receive the interest payments? What will happen if the exchange rate goes down? Then we will receive less money. So in advance, they cover their position. They purchase forward rate or future rates. They enter into a contract in advance so that when they receive the interest, so they can transfer at the contract rate and they get benefited from that. So this whole transaction is called covered interest arbitrage. So what is the definition? A process of capitalizing on the interest rate differential between two countries while covering your exchange rate risk. Right? So due to covered interest arbitrage, market forces should realign the relationships between the interest rate differential of two currencies and a forward premium on the forward exchange rate between the two countries. What does it mean? It means you are not the only one who is doing covered interest arbitrage. If this kind of opportunity comes, so you are not the only one who want to invest in that country. Everybody start doing that and enter into a forward contract, right? So if everybody wants to do that, the market forces, demand and supply, will realign, and the forward, which is spot rate into 1 plus premium, so premium start rising. When premium start rising, you would be getting a higher forward rate. So that will be basically eliminating that opportunity as well. So those who exploit it first, they will get the desired income, and later on the markets will realign the relationships. So that country whose interest rate is higher, their forward premiums start going up. So you would be, like you won't see any kind of profitability in that one, any attraction in that one. So I have a very nice video. It will further clarify your concept. What is covered interest arbitrage? So if the word written here uncovered, what do we mean by uncovered? That you just